There's a lot to talk about. BTC, obviously. I want to talk about metals. I think a lot of people have probably gotten Stockholm syndromed by crypto, and I think it's nice now that there are exchanges where you can trade traditional market assets, whether that's metals or stocks. They're obviously going to be detached from traditional markets over the weekend, but I think a lot of people got Stockholm syndromed by crypto and have put too much attention on crypto when, markets outside of crypto. They were trading like crypto in 2017. I think that my primary focus is probably still going to be silver and gold for the foreseeable future. It's just where the action is right now, but we'll get into that. So just to cover things real quick, back in December, I said that the lows were likely not in. So if we zoom out on BTC, we look at where we were trading back in December, we had this 2-month long range, and my opinion was, and I was pretty steadfast about this, was that significant changes in trend like this are extremely meaningful. The concept of big ships turn slowly. When they turn, ultimately, they don't change direction that fast, right? They have a level of inertia. So my idea was that we were going to be trading back up to the 20 weekly moving average, which is a level where I assume we'd see some more systematic selling get involved. And just to clarify, the 20 period weekly moving average, that's right here. I use an EMA for the faster stuff. That to me is probably one of the most important lines in the sand for the high time frame trend. I've said this before, if I am not in position aligned with that trend by the time that ultimately crosses, I am making a mistake, and at that point I have to adapt. I had the benefit of leaning into this swing failure on the high time frame. Right. I think what we see actually happening in the tape, they supersede, or they exceed rather, anything that's taking place from a narrative standpoint, anything that's taking place from a macro standpoint, right? Most of the time you're going to see that the story will ultimately follow price. I was lucky enough to get out of BTC largely, right? A lot of my exposure, hedging a lot of my exposure on this SFP. The idea with the 20 period EMA is that if I hadn't done something like that by that point, once we're starting to close back below that, I have to adjust. So the same thing works for the upside. If we're trending down, let's say we spend all 2026, moving lower, ranging. The same thing works on the top side of that. So if we're back above the 20 EMA on the weekly, and I don't have any kind of core position started, I have to be involved at that point, okay? I've talked about this before. If price action is noisy, then EMAs and moving averages, there's sometimes a more honest representation of the true price, right? Of the true fundamental price. It's far less subjective than focusing on what can be very noisy price action, especially in the low time frames. So the high time frames, this is not that significant. But high time frame wise, my view has always been, we're trading back up to this 20 and we're going to test Saylor's number. We're at Saylor's number, right? We're below Saylor's number. It's not as significant as people perceive it to be, right? So Saylor's not at any risk of liquidation in the near term, right? I mean, he has a lot of runway, but it's the same kind of thing as the quantum threat right now. We know that this is more than just conjecture at this point, because Novogratz said that they had a $9 billion whale exit because of quantum fears. So there's a lot of reasons why this tape is heavy right now, right? There's a lot of things we could point to. Ultimately, I think the most important thing is price though, right? So when the higher time frame trend begins to turn, and if the market is especially still very negative in the face of that, that's a meaningful signal. But right now, the news is bad and the price action is bad. But with regard to Saylor's number, right? It's the same thing as the quantum threat. Consider it like this. The quantum threat is, I think, in terms of it being substantiated by expert opinion, I think that's probably a bit overstated from what I'm gathering. But you have to understand that perception is everything. If there was an asteroid that was going to approach Earth, right? It's approaching Earth, it's barreling towards Earth, right? We're in a cosmic shooting gallery. If that was barreling towards Earth, but the world's leading scientists, right? The people that were, astrophysicists and people studying day in and day out were telling us, listen, this is going to travel all the way to Earth's atmosphere, but it's actually going to fucking pivot the last second, right? 99.99999% chance that's going to happen. That would not matter, right? If they were standing and saying that on a pedestal across the globe, right? And everyone else was watching that asteroid approach, right? Regardless of them knowing better that, again, we were going to destroy it or something like that, people would still be acting like it was an end of days situation. There's hysteria when there's anything really negative and looming on the horizon. So I think the same thing can be said for the quantum effect, right? The quantum threat. I think the same thing can be said for trading below Saylor's price. So I think it's really important that price does find some kind of temporary base around this level and actually does settle, because I think that the further we push below that, right, the more disinterested and spooked people are going to be. A better example is Tom Lee's average right now is 3,800, but high time frame. Anyhow, trend is objectively down. Just going to go over some basic shit here right now, because I think most people, they lack context and especially in this market, there's a good amount of assumptions I think we could make generally, but one of them is you don't really need to fight is when the trend turns. Use moving averages, use longer term VWAPs. These are things that make it a little bit less subjective. Moving averages are leaned on by trend followers, right? People that trade a bit more systematically, people that a lot of times enforce the trend with a bit more capital than, a small spec intraday trader, right? So intraday, you could have all these flows that are counter trend, but the bigger shift, the thing that moves the tide, right, is all pointing down. So averages, higher time frame averages, higher time frame VWAPs, okay? You could think about averages and VWAPs as kind of the same thing. If you are trading above averages, right, you could say if you're trending healthily higher, that the cost basis is sitting below price more often than not. So the average cost basis, I think, is a safe assumption. If you're trading below it, right, whether it's shorter period, I like the 20 EMA, the 50 SMA, the 120, and then the 200 SMA. These are things that I've always respected, by the way. As a person who trades intraday and trades anywhere from 2 minutes to 2 weeks, the higher time frame is really important to understand, right? To determine whether or not we're in a range-bound set of conditions or a significant trend is at our back for just that reason. You want to know whether or not you're pissing against the wind or pissing with the wind, right? Swimming upstream versus swimming downstream. So when this changes, right, when we're trading below the higher time frame moving averages and the faster period, right, the faster period 20 and then the longer period, just take it as we are trading below the cost basis of the average participant. If we were relying on the marginal buyer back here to do work, which is not something that's necessarily good, then the fact that we're consistently trading below these levels is just a really bad sign. People are put underwater, right? The market is just positions, as I said numerous times, right? This goes back to Michael Platt, right? Of Blue Crest Capital Management, okay? So trend is objectively down, right? Nothing is supportive right now. The bears definitely have the ball in their court. Over the weekend, right? So the first trade we looked for off of Sunday futures open and Monday was the short back into the CME gap. So I'll go over that in a second. But I just want to drive this point home. There's not a lot of thinking that's required for this, right? The default assumption in this market should be, one, it's more often than not easy to just say that if there's leverage getting involved, that it's on the long side, right? The default assumption should more often than not be that there are not a predominant amount of sellers driving things in this market, right? But there are people that are constantly trying to buy the dip. The least savvy participants, right? Constantly trying to buy the dip, constantly trying to aggressively put in a low, right? And then more often than not doing that with leverage. So this dip right here locally, in my opinion, right, this break through these lows especially was not along for a multitude of reasons. One of them is the trend broke back here. I see people fighting it right now, so I just want to get this out there. This is a 2 month long range, right? So there's a significant amount of turnover that took place within here, long, shorts, mix, right? Open interest is not that elevated, right? The market is, if anything, disinterested. So there's not like a ton of crowded positioning that has gotten involved where we could say, hey, there's a bunch of short fuel, right? This range right here was dealing with the overhead supply that was put underwater right here. Immediately, there's an imbalance of inventory that the market is trying to assess. And you have a 2 month long range. The market chooses a side after that, right? This is with the trend. Mind you, this is with the trend. This chose a side up here, but that's not with the trend. That's dealing with inventory up here. So immediately when the market trades below this, something like this, you should not be fucking thinking about buying the dip instantly. What you should be thinking is, wow, all right, so we've had 2 months of interaction, right? Buyers and sellers getting involved, people getting confident that this is a dip, right? Just look at the timeline, right? If there's one instance of that. And now we're trading on the other side of that. So a very simple concept, right? Cost basis is up here, position is, the market is down here. And you don't often see that people respond immediately to the market pushing against their position. You kind of have to get to that 5-10% window away before they start to really get spooked. So this overall trend being down leaves positioning twitchy. So any kind of long down here, any kind of position that was taken down here has to assume that there's still a lot of baked in overhead supply that's looking to exit. Basic concept. I think most people can kind of understand this, but I think sometimes you have to put it in pretty simple terms or oversimplify it. There's not a whole lot of meat in terms of where it makes sense for things to pause. There's a couple different ways you could cut this, right? You could look at like yearly VWAPs, right? Put on like a yearly VWAP right now. We're trading at the 2 standard deviation band, that last yearly VWAP, right? So you could say that that's like a yearly value area. We're trading back below all significant moving averages though, and now we're trading back to prior high time frame market structure. So this is probably the most substantial argument you could make for a low to develop in this region, right? But it's still really early. Seller's cost basis right here. I would say this area kind of now does make sense to see a shove, right? A shove meaning like we get some kind of splashdown through 73. We had to push through 73, but some kind of push through, let's say 73 down to 68. I could see us developing, maybe a multi-week range or even longer in this region. Besides that, right, besides this higher time frame market structure, the next major area I think that really absolutely makes sense is the 200 weekly moving average, right? So there's your 200 weekly moving average. Again, we're well below the 200-day moving average right now. But the 200 weekly has been an area that has been in the past a really reliable level. And this is like from a high time frame trend following standpoint, this makes sense. It's kind of like returning back to fair value over time. In a sense, the most significant mean reversion you could have. There's a few people that have pointed out on the daily that we're oversold. Right. So first time oversold in a while, right? Since going back to November. You should think about oversold as just really strong, right? You shouldn't think about oversold as like, we need to take some kind of positioning against this. The market is too oversold right now. Sellers have to lose a little bit of control for the time being. No, if anything, oversold just means that the trend is really strong. When you look at the weekly right now, we're not oversold yet, but we are continuously pressing in that territory. I look at something like this and I say, what are the chances that something that continues with this amount of momentum and is picking up does not go oversold? All right, so the chances are, I'd say the chances are upwards of, 80%. If that's the case, it's more common for us to continue just push in this direction, right? Price has momentum at this point. Then you have to look at this and say, all right, if this is not oversold now, there's still meat on the bone before it's oversold, right? And then ultimately when it is oversold, it's usually the case that if it's oversold in the high time frame, that's your warning shot. So meaning the first oversold that you get is often not going to be as deep as the next move, right? But the market might lose momentum in attempting to make that next low. There's plenty of time for you to sit, to trade intraday, and to let a meaningful low develop. Does that make sense? I wanted to get that out there first. I think people should get the idea of buying the Pico low out of their head, right? There's been no reason to be overly focused on BTC and focused on crypto for the last few months at all, right? It has been a complete waste of time relative to what has been taking place in traditional markets, and I don't think that's going to change in the very near future. Silver and gold, like you'd have to live under a rock to not know what took place last week. So massive moves. Now there's debate whether or not this changes the trade, right? I think a crack in the trend is the most important thing. So my signal with silver and gold has always been in engulfing on the daily. This is more than that, right? So there's a couple times when we got false feedback, right? So more recently, you had an engulfing back here on silver. The last one was really actionable before that. So you had an engulfing back here. And this is just when we start to open up to the idea that the market's going to find some kind of range or is going to start to range. I think this is probably, from an ATR standpoint, silver and gold, like it's expanded because of this move down, right? So just again, focusing on ATR. One, ATR is useful if you're trying to get an idea of like where you should take profit for setups, how you should rate your trading, maybe intraday, right? If you captured a significant portion of ATR or even a multiple of it, ATR is expanding, right? And this is largely because of this move, but I think these are bound to trade loose in the near term. They're trading like shitcoins. I think Bloomberg said something along the lines of them trading like meme coins recently. If you look at the spreads in gold, right, this is what you're dealing with. So it ain't tight right now. Price is trading a bit erratic. I think after this kind of move, you look for a range to develop. We look for value to establish, and you didn't have that immediately with silver or gold. Instead, we had value migration higher over the last two sessions. So the setup that we looked for, we shared in the stable on Monday, was buying down to this value area low on the presumption that we would get a trade back up, right? We would probably trade back up towards prior day highs through prior day sessions, right? So we bought down to 46.60, 46.50 region and ended up longing and closing this out. I think what we're looking for right now is some kind of high to form in the short term. So gold, good on the long side from a scalp standpoint. Intraday, I was saying this in the stable, but I think we're kind of approaching an area where I would expect gold to turn. And then what we're looking for is some kind of value overlap. We're looking for multiple days of value to form. We're respecting previous day value and then ultimately a range, right? I don't think that this kind of move leads to another massive continuation move. I think if anything, this is what we're looking at here. We're looking at somewhere between, we'll say, be a little bit more generous. I think 52 is kind of a long shot. Similar to what we had back here, a massive range forming, right? Something that's a tradable range, right? You're trading the composites within that range, but not getting excited and looking for the debasement trade or whatever trade, whether it's silver, industrial use case trade to pick up. Price is the most important thing right now. And this got super crowded and blew off. Like there's no debating that. So in terms of levels though, this, I think from a yearly VWAP standpoint, gold is clean, right? Gold is, and just look at the 1 standard deviation bands, it's kind of like yearly value. I think anywhere with gold, anywhere between 51 and 52 is fair game for a high to develop. So meaning if we're pressing up there, and let's say we continue to, and I'll still trade this on the long side if this happens. Let's say we continue to trade, hold previous day value, right? We're holding VWAP. I'll continue to trade this on the long side up through those levels, right? Very tight stop, as I was saying this in the stable today. But as soon as we get something where the market trades up, right? Let's say we have some exhaustive move through here, and then we're reoffered. Let's say tomorrow we start basing out. If we start to get reoffered, like for example, get reoffered below today's POC, losing VWAP, right? 1 hour trend also, right? So if we zoom in over here, we just put on the 1 hour trend. And for me, 1 hour trend, by the way, is just a 20 period. If we start to trade back below that, right? It's kind of what we're respecting right now, respected on the way down. If we start to trade back below that and we're reoffered underneath previous session, so whether that is from higher, right? Which is not even going to talk about the hypothetical yet because I'm not just going to draw something out. But let's say we do something like this where suddenly we're reoffered back below a previous day value, or we've trapped a good amount of inventory here now, and we're trading back into prior day value. You're rolling back below these averages. I think you get aggressive again towards any kind of standout sweep, a level where it makes sense that the market would sweep. So maybe that means getting aggressive from 48.40 down to 46, right? Trading down to 40.40. But overall, I think when I look at something like this, I say, don't get aggressive up here on the long side. Don't get aggressive down here on the short side. Look for the developing range. And I think that is the most likely outcome with gold. And it might mean that we spend more time, if anything. So I could see, if I was going to just play this guessing game, which I don't like to do too much of, I could see us forming value down here, favoring down here more. It's going to make sense to not aggressively sell towards 44 and not get overly aggressive and overzealous towards 52, and to look to just play a more rotational market. Let's say we trade up in the overnight, we're trading through 51. The more likely I am to put on starter positions. So I talked about this in the stable. I talked about, sizing into mean reversion trades versus trend trades. For me, what that means is we start trading through the level and having some kind of response. I'll tag on about 25% of a position. Let's say we trade up, make another lower high, have a rejection. I'll throw on another 25, right? A lot of times those might be more along the same levels. When you do actually have a breakdown and we start to lose a significant level, that's when I'll add the remaining 50. Mean reversion trades are tough to call in terms of what signifies the turn. Whereas trend trades, we could say, hey, the trend is very objectively this. We're making a series of higher highs and higher lows. We're holding these moving averages. In trends and breakouts, it makes sense to add more earlier. Add more earlier because you don't know if the market's going to pull back necessarily immediately. So I'd add 50 and then 25, 25. I'm more inclined to add a feeler up here, add a pilot position as we trade through 51. And then invalidation would be probably more along the lines of like 51.30. So after big breaks like this, just a simple heuristic, after you have these big breaks, the last low, so this level right here, is very rarely fucked with too much. Maybe you get some kind of brief spike at that level, but it's usually that it will die before that. So I think we have to start looking for that. If we're hugging VWAP, right? And a good thing to focus on would be just, hey, where are we sitting relative to that 1 standard deviation band off of an anchor VWAP off the low? Kind of hugging that. If we're starting to trade back below that, this 1 standard deviation band right here, this is within that. Right, that gray area. If we're starting to trade back below that, again, under session VWAP, I think you side with flows at that point. I'm more inclined to trade gold than silver. I missed out on a lot of silver trading gold. A couple things worth pointing out, and I said this in the stable earlier, this to me looked like a long. This is a couple hours old, but the plan this morning was, hey, back down to prior day value area. I don't think silver is going to really turn similar to gold until we close out more of these gaps up here. So anything that rotates back down to this HVN and back down to mostly to the prior day value area and today's value area, that looks good on the long side. So to me, this looks like something that has another push. If you need some added confluence, you have a poor high here. Right, so you had a poor high yesterday and you have a poor high today. Something like this can be left behind, right? Something like this is kind of egregious. You rarely see that gets left behind, so I'd expect something like this. And then the further we trade towards 100, 95, 100 for silver, I'd just be way more inclined to, again, look for the same thing that I mentioned with gold, where we're just going to have more of a rotational market. In these conditions, by the way, this is something where if you're just a pure value trader, we're just a TPO purist. This is something where if we're starting to trade back within previous day value, like these setups become really actionable. Small scalps, right? Back to prior days, chunky areas, POC, prior day value area low, looking for a larger carve out to develop. Target for this, I think it makes sense though for this to continue to push up. You have that yearly VWAP, by the way. So just as added confluence, you have that yearly VWAP, and that's also right around that 20 period EMA. As many pieces of confluence as you can add up to, stack in favor of your trades, the better. Obviously, you don't want to have too many boxes to check. Every little box you check to add on to that isn't necessarily adding more weight to the trade as much as is adding more weight to your overall levels of confidence. So I think the trade is over for these. I think the easy long is over. I don't think, though, you just aggressively short these, right? I think we develop somewhere within this region and we build a longer range. I find it very unlikely. It would be very hard to believe that these can just continue their pace that they had previously. Sometimes it pays to overly simplify things. These kind of massive liquidations, right? People are out of the market at this point. Accounts are lost at this point completely. So the firepower that you need to move up is suddenly reduced by a massive amount. It was not institutions getting aggressive behind silver up here, right? It was a lot of retail piling into momentum. And momentum traders tend to put in tops. You're being rewarded and you're being saved by the trend constantly. So you get things like this where the final move, and I'd said this a couple of months ago, I said in silver, we're going to have a 20% down day. I didn't expect a 28% down move in like whatever, it was like a matter of hours or something. But to move back up, you need more buyers, right? Just as simple as possible. You have less people now that are able to buy. When you kill people, literally, when you take people out of the market completely, you wipe their game board, you take all their money in Monopoly, they're no longer able to participate in this trend, and then this trend just loses a little bit of gas. Thanks for tuning in. How about we get together again next Tuesday?